Hi everyone, good afternoon and welcome to First Capital's Mid-Year Outlook webinar titled Stand Still, the Cloud of Elections. I'm Ranjan Matthew, Senior Research Associate at First Capital Holdings, and I'll be your host for today. We are glad to have you here with us as we dive in to look at the economic developments of 2024 so far, and also as we discuss what may lie ahead, particularly in the context of the upcoming elections. So today's discussion will focus primarily on the overall economic outlook and also a scenario analysis where we will evaluate the best and worst possible outcomes for Sri Lanka's economy following the elections. We will also discuss the key elements that we need to consider for investments, and then we'll provide an overview of First Capital's strategic recommendations. So this webinar is scheduled to last for about an hour, and we will leave some time at the end for a Q&A session. So we do ask that you feel free to type any questions in the Q&A box, and we will do our best to answer all of them at the end of the webinar. So before we get started, I would like to introduce our speakers for today. Dimantha Mathew, the Chief Research and Strategy Officer at First Capital, and Ranjan Ranatunga, the Assistant Vice President of Research at First Capital. So I'll now hand the floor over to Dimantha to start us off with an overview of the economic outlook so far.
Good evening, ladies and gentlemen. As Anjali pointed out, it is a period of uncertainty. On one side, we have the IMF program that needs to be continued. On the other side, you have the political and policy level uncertainty. And then, finally, also you have the requirement to do the reforms and also the external debt restructuring. So in this outlook, how do we manage investments? So let me take you through a quote by Benjamin Graham. He says that successful investments is all about managing risk and not avoiding it. So let us take you through the situation and the different scenarios that will help you understand how to make successful decisions while also managing risk. So there is a significant risk out there, but we need to manage it and also go ahead with the investments. So here in this presentation, we would like to take you through three specific areas. First, we will be starting off with the track record of First Capital. There, we will be taking you through how First Capital has performed over the last 12 months. And then, secondly, we will be looking at the key economic indicators. So here we will be looking at basically the outlook for the next 12 months and also the forecast that we've done. And then finally we will be looking at the recommendations. So let's start off with the presentation, and here we will be starting off with the track record. So starting off in terms of the accuracy, let me take you through. So this is the levels of accuracy that we have. 80 to 100% is, we take it as accurate, and then you have the mostly accurate, partly accurate, weak accuracy, and finally the inaccurate level. So if you look at the most of the economic indicators that we forecast, we've put in here the main 6 items. So you can see that we've been broadly accurate in most of the indicators, starting off with the tourist arrivals and tourism earnings. You can see during the first 7 months and also the first half of the year, there we've been at least half of the amounts have been achieved in terms of tourism earnings, and then 58% in terms of tourist arrivals for the first 7 months. Then you go take into account the worker remittances, almost 50% done. In terms of private sector credit, the credit level is 2%, and here what we understand is that we expected the first half to be a bit slow, and then during the second half for private credit to accelerate. So there we've been accurate there as well. So we've achieved 2% credit growth, and the balanced credit growth we think can be achieved during the next couple of months, or during the rest of the year. So then also in terms of foreign reserves, we've been broadly accurate there, and we think our target can be achieved. However, if you take inflation wise, we think the inflation what has come out has been well below our expectations. So there we are looking at a revision here. Starting off in terms of the products, our recommendation in terms of bonds have been broadly accurate during the second half of last year, where there was a significant decline in the bond yields after the domestic debt restructuring in line with expectation. However, there was an accelerated decline. And then during the first half of this year also, the decline was broadly in line with expectation. However, towards the latter part of last year, though we advanced our recommendations, that was broadly not in line. So overall, we think we've been broadly accurate, and the yields have broadly come down below the 13.5% mark which we've targeted. So this is how during the by early July how the yields have been. As you can see, yields have come down to our targeted range. 1 year of course slightly below our range as well. However, the 10-year is the only one that is slightly above our range. Yeah. So this is something that we've put out for you to show how the yield curve has moved throughout the year. So you can see the second half of last year and first half of this year how the rates have moved. Going on to the policy rates, so second half of last year we've been broadly accurate. However, if you take the first half of this year, we expected policy rates to be stable. However, central bank did give a 50 basis point rate cut in March and another 25 in July, which was not expected, because we in line of what we expected, the yields really did not react to the policy rate cut. So that was expected, because the yields are remaining elevated simply because of the uncertainty that is there, and also because of the external debt restructuring delays that are there. So that is understood why that is there. However, we did not expect a couple of rate cuts that was given by the central bank. In terms of AWPLR, of course, in line with our expectation, there was accelerated decline, and rates have actually fallen below our expected range as well. In terms of exchange rate, we are looking at a partly accurate level here. That's because second half of the year was broadly more in line with our expectation, but then with a possible economic recovery, we were expecting some amount of a depreciation in the currency, which did not really happen. Now what happened was the economy sort of slowed down, and with that we saw the currency sort of looking at appreciation. Now with that we had to revise our expectations in May, and currently the rates have moved broadly in line with our May expectations. So in terms of equity market, we've been mostly accurate here. You can see over the last 12 months up to July, the returns have been very strong, 21%. So there, what we expect, contrary to our expectation, there were slight slowdowns in the fourth quarter and also the second quarter of this year, primarily because of the uncertainty with the delays in the IMF program. However, the returns have been so far healthy over the up to July. So now let us look at what the key elements are there for consideration. So here we want to look at, let's first look at the theme for the evening, which is stand still, the cloud of elections. So here what we want to let you know is that we were expecting the IMF agreement to stay put and the reform agenda to continue. So those are the key elements that we need to look out for in the economy. Also here something important to understand is currently we are facing some elections, and that's likely to be there over the next 12 months as well. So with that, will the new government or the new leader go ahead with the reforms that are required, and how successful will the reforms be? So that is something to consider. So let us look at what's happening. So we are taking this in 3 specific areas. So we'll first look at the political outlook, then the economic outlook, and the external side. So political side, we think, is very critical. As you can see, currently the overall economic is completely at a standstill, and that is primarily because of the election that is there. Now this is why we say that the risk level is pretty high. So we classify this as medium high. So we are maintaining the risk level primarily because we've already downgraded the risk last January. So in line with our expectation, the presidential election has been called on the 21st of September, and soon after it we are expecting a general election to come. Now that is because that is expected in line with December 2024 to February 25. That within that period, within the general election is likely to come, and it's not going to stop there. We are likely to see the provincial council election, then the local government election. So with the continuous flow of elections, we think there is some amount of uncertainty that will come to the investors' mindset. However, something to note is that with the continuous flow of elections, the IMF agreement also has to be maintained. So with that, the new leadership will have to continue with the fulfilling the conditions of the IMF. So that is a critical part, and that is something of a savior for the investors, where because of that there could be some amount of certainty that could come into the economy. Next, we need to look at the economic outlook. So we think the economy is on a recovery course. However, the reform agenda is very critical. Now here, let's start off with the GDP. Now we think the GDP is sort of broadly on course, and we are maintaining our expectations for 2024. 2% to 3% is our expectations. Sorry. So in the first quarter, we expected the growth to be the growth that actually came out is around 5%. So here, what we think is basically, though it was around the 5% mark, towards the second half of the year, the growth is likely to slightly slow down because of the one thing is the higher base effect, and now you can see the overall slowdown in the economy taking place because of the election season that is there. So with that, we feel that there is some amount of uncertainty. So the 2 to 3% level is appropriate at the moment, and you can see the international agencies also has expectation around those levels. So looking at inflation, something important to take into note is that we've revised our inflation numbers, and we believe that it's likely to be maintained around the 2 to 3% mark, and next year maybe mostly below the 5% mark coming in. So also something to note is that I think a couple of days ago, even the central bank governor mentioned the fact that during 2024 and 2025, you're likely to have inflation below the 5% mark, so which is broadly in line with our report which we published last week. So next, with this, we are seeing that the real wages are actually improving in line with our expectations. So the public wages have significantly improved. That is because of the wage hikes, but private sector wages are also broadly moving up in line with that. And if you take the consumer demand, so that is also sort of on a upward trend despite the volatility that is there. So that is something to take into consideration, that broadly the economy is on a recovery path. And then business activity and the sentiment. So broadly it has been on a recovery trend, and also if you take the PMI, the Purchasing Managers Index, you can see the manufacturing services and also the construction segments are on the positive side or above the 50 mark, which is where the industries are on an expansionary trend during 2024, except obviously in the month of April, which was a bit of a slow month. And then private sector credit growth broadly in line with our expectation. We are now starting to see acceleration in the month of June and July. You saw 60 to 70 billion of credit growth happening. However, again we expect August and September to be a bit slow simply because of the elections that is there, and then towards the end of the year another acceleration likely to happen. So 7.5% is our expected private sector credit growth, and we don't think liquidity will be too much of an issue, because as you can see on the other side, state credit is actually on a contracting trend. So on the liquidity front, you can see that liquidity has improved during this year. This was a problem last year. So overnight liquidity has improved to 80 to 100 billion, and we can say that with the term reverse repo, and the central bank seems to be maintaining around that level. And if you take the total outstanding liquidity, there also we are expecting it to be maintained. Currently you can see it's being maintained around the 30 to 50 billion mark. So this is also the improvement in liquidity is primarily led by the dollar purchases by the central bank. So you can see in the month, especially in the month of March, April, May, there was a significant increase in net purchases, and then subsided a bit, but again in July you can see the net purchases coming in, however much lower than March, April and May. And with that, despite the dollars being purchases, you know that when you do purchase dollars, you need to release some rupees into the system. So with that, liquidity needs to improve. However, here what we are looking at showing is there is quantitative tightening also taking place simultaneously, which helps to which actually brings down the level of liquidity. So they are maintaining liquidity at a certain level. So you can see just after the domestic debt restructuring, there was a spike in the CBSL holdings, and then it has been brought down, and then currently it is at the same level as 1 year ago, in August 2023. So then we go into the other expectations of or the economic indicators. Let me hand over proceedings to Ranjan, who will take you through the rest of the economic indicators and also the external environment, how things are moving around there. Over to you, Ranjan.
Thank you, Dimantha. So now have we looked at, since Dimantha has taken us through the fiscal side, what is going to drive GDP. Now let's look at on the external side, what is going to drive GDP as well. So starting off with manufacturing and construction sector PMIs. So why we have taken this into consideration here is because there has been a steep improvement in both the indices. where we have seen manufacturing and services indices picking up and crossing the neutral threshold since the beginning of this year, partly contributed by the recovery in the apparel sector together with the booming tourism sector that we have seen, which has contributed towards the pickup in activities. On the construction side, we have seen construction activity have surpassed the neutral threshold as well. So one of the main reasons that has been driving this, the boom in the recovery in the construction sector that we have seen is the resumption of the donor-funded projects. For instance, you all may have seen during these days that there were the work on the flyovers, the highways, and the road development projects have all resumed right now. So all these are donor-funded projects, and this is what been driving construction sector PMI forward as well. And just to add on to that, so we have also seen a drastic reduction in construction material prices, which have also contributed towards the pickup in retail construction as well, while the reduction in interest rates have also contributed to this. Yeah. So with the expansion in the economic activities that we are seeing, we are expected to see a pickup in export side as well. And the main reasons why we are highlighting this is because the export side is one of the most crucial sectors for Sri Lanka, and the growth that we expect to see from the apparel and as well as tea exports is one of the main reasons for the export side to pick up. While also on the other side, we have seen additional demand coming towards the port activity side as well because of the current crisis that is prevailing in the Middle East. So saying about that, given that we are a net importer, with the recovery in exports that we are expecting, we are expecting improvement and escalation in imports as well. So if I look, for example, if you look at apparel and apparel industry, a lot of articles of apparel is bought to Sri Lanka through imports. While if you look at the from the bunkering side as well, oil is imported for bunkering. So these all together will boost imports as well, in line with the booming exports that we are expecting. So with that said, with the escalation in imports, we are expecting the trade balance to be somewhere around 5 billion for this year, while this is expected to go up to about 5.6 billion in next year. Yeah. So with trade adding a bit of pressure towards the books of Sri Lanka, the pressure is somewhat expected to ease from the inflows that were expected from tourism side. So talking about tourism, for this year, we are expecting 2 million arrivals for this year. However, this will be slightly lower than the pre-pandemic arrivals. That's the best year we had in 2018, arrivals of 2.3 million. However, on a positive note, what we have to highlight is that although we are falling a bit short on arrivals compared to pre-pandemic, next year we are expected to exceed the old target and hit about 2.5 million arrivals in terms of tourist arrivals. While this is also expected to bring in possible earnings from tourism, which is expected to support, give cushion towards the BOP as well. And also one of the main things that we had to talk about in terms of BOP is the worker remittances. So in terms of worker remittances also, we have seen very good growth in the past few months. And we have seen growth coming in on an average of around 10% growth year over year. And this has contributed towards the growth in remittances that we have seen, and we are expecting it to perform in the coming months as well. Then something interesting to look at is how the multilateral funding is going to come into Sri Lanka in the next 24 months. So starting off with the IMF, yeah. So IMF gives us 2 tranches every year, totaling up to about $660 million. And so far for this year, we have received 1 tranche that is in March of $330 million. And with the possible completion of extended restructuring and the 3rd review, we will see the 4th tranche towards the end of this year as well. So this will bring in another $330 million to the Sri Lanka. While on the other side, there are different multilateral agencies, including ADB as well as World Bank, which will be also supporting through inflows, which can help us to balance the books of Sri Lanka. Then finally, there's the 3rd component that is there as well. That is the possible inflows that will come from the bilateral debt side. So for bilateral debt to unlock, we had to think is that external debt restructuring needs to be complete. And we have already heard from ministers in Japan and all that, that once the debt restructuring is complete and the memorandum MOUs are signed, we will see the resumption of bilateral debt getting unlocked as well. So with this, we are expecting a few inflows to come from there as well, from countries like Japan and India. So considering all these factors, let's look at how the BOP is going to get affected. So in terms of BOP, we will see a bit of pressure coming towards BOP compared to previous years, partly because of the resumption of debt repayments. So as we mentioned before, we are expecting the conclusion of EDR very soon, and with this, Sri Lanka may have to repay debt again. So partly offsetting the possible inflows that are expecting from the tourist arrivals, from remittances to possible monetary inflows, we are expecting somewhat an impact to come towards BOP surplus from repayments, which is why we are seeing a slight decline in BOP in the coming months. However, this is still expected to remain a surplus in the next 2 years. Yeah. Coming off from BOP, next up what we're talking is the reserve question. So in terms of reserves, we have seen Sri Lanka hitting rock bottom of reserves in 2022, where our usable reserves fell down to about $50 million. But since then, we have been on a very positive trajectory. And with our expectation, we believe that Sri Lanka is poised to achieve somewhere around $6.3 billion for this year in terms of reserves, while this can go up to $7 billion by next year. So having discussed the external side of it, now let's look at the finances side of Sri Lanka. So when you're talking about the finances, main thing that comes up to mind is the revenues. So in terms of revenues, we have seen very good numbers coming so far as well. So for the half year so far, we have Sri Lanka has recorded about 1.7 trillion rupees of revenues coming in. Most of them has been contributed by taxes. So if you look at the last couple of months, you may remember that Sri Lanka increased the personal tax levels from January of this year, while value-added tax has also been increased to 18% from 15% from January onwards. So these, together with the enactments that were there, together with the broad basing of the tax base, we have seen revenues climbing as well. And we believe, given that the first half performance has come in line with our expectations, we believe that the 3.2 trillion target that we have set for this year can be achieved. While for next year, if you look at for next year, we are expecting somewhere around 3.5 million trillion in terms for revenues. Something note here is that in terms of IMF, they guide us on the targets that are set. For example, if you look here, in terms of revenue to GDP, what IMF highlights is that we need, by next year, we need to build up revenue to GDP to 14%, from currently around 12% right now. So that bit of a jump is what we are looking for in the next year as well. And now, having talked about the revenue side, let's look at how the improvement in revenue is going to help us to achieve a primary surplus. So for this year, we are expecting a primary surplus and continue from last year. However, this surplus is going to be slightly adjusted, because mainly due to the incremental expenses that we are seeing, which has been coming from increment in wages. So all these factors combined will add a bit of pressure to the expenditure side, while the primary surplus is primary balance is still continue to be a surplus levels at the end of the year, with primary surplus as a percentage of budget deficit as a percentage of GDP is expected to come down to 7.1% this year from 8% levels recorded last year, while going towards 2025, this is expected to further come down to about 5% levels. So when you look at the expenditure side, one of the biggest components that Sri Lanka has is the debt service payments and the debt repayments. So in terms of debt repayments, it's interesting to see how the T-bill stock is piling up for Sri Lanka. And if you can see on the left-hand side, we have seen T-bill stock coming down drastically. For example, if you look at last year June, our T-bill stock hit 5.3 trillion, but now it has fallen down to 3.8 trillion. And on the other side as well, we have seen T-bill as a percentage of GDP has also been coming down, and this is been evident from the chart on the right-hand side. And while looking at the T-bill side, it is interesting to look at how the bond maturities are also there. So in the coming quarters, we are expecting bond maturity to be slightly lower from how it has been in the previous quarters as well. And with this, we are expecting somewhat of an ease coming to books as well. While when you're talking about repayments, I think this is an important slide. We have to bring it here because this is the last stage of debt restructuring that we are currently on. That is the commercial debt discussions. So as President Ranil Wickremesinghe highlighted in July, Sri Lanka entered into preliminary agreements with the creditors to restructure $12.6 billion of debt. But however, we are still awaiting the IMF approval for this document to proceed with the finalization of the stuff. So with this, we have so there has been a haircut being discussed for about totaling up to about 28% on the outstanding payments, outstanding principal amounts, while another 15% haircut is there for the $1.5 billion of outstanding interest as well. Then with the possible restructure scenario, this is how the maturities will pile up in the coming months. Where earlier what there's with the dark blue line, where pre-restructure we had about $1.7 billion expiring every year. So these maturities have been pushed towards the latter years, where a more evened out repayment schedule is there. So this is the proposal that has been submitted to the private creditors as well, where there is a couple of factors there, including a macro-linked bond as well as vanilla bonds. So with interest rates going up to 4.25% from 4% starting in 2024. Yeah. So this is an interesting slide that we have been putting up since our last presentation, where we have been looking at the track record. So we have been looking at the next few steps of the for Sri Lanka in terms of progress. So we have revised the timelines a bit on this because we have seen the third review getting dragged a bit in terms of IMF. That is partly coming off due to the delays in confirming the EDR. So because of this fact, we have pushed our timelines by 2 months. And so with this, one of the next milestone that is coming is the presidential election. As Dimantha explained, the presidential election is due on September 21st, and this has been in line with the expectations, where we were expecting elections to take place in September. While next crucial step is the approval of the EDR by the IMF. So this will enable us to unlock the to successfully complete the IMF third meeting, while allowing us to unlock the fourth tranche from IMF of 330 million. So this is expected to take place between September to October of this year. While finally the exchanging of the bonds with the signing of the MOUs is expected to take place in November, while the implementation will also happen in November. So with this, we are expecting a credit rating upgrade as well, which, like we have seen post domestic debt restructuring that we saw in September 2023. So with that in mind, we have, so just to mention it, we have pushed our recommendation, our credit rating upgrade period as well from September to November of this year. And again, we are expecting general elections to take place in between December to Feb of next year, while there is IMF another meeting happening possibly towards May of next year as well. Finally, looking at the overall how the economic picture is panning out, we are maintaining our outlook at medium-low risk because of the evened out positives and negatives in the economic scenario. Then looking at the external side, there are a few factors that is adding up pressure towards Sri Lanka as well. One thing is how the possible global interest rates will behave. For if you look at the current situation globally, we have seen most of the countries at peak interest rates. For example, we have seen the Federal Reserve maintain the highest interest rates they have seen in the past history at 5.25%, while the ECB, that is England Bank of England, is maintaining interest rates at 5%, while European Central Bank is also maintaining interest rate around 5.75%. So this has been this has been one of the biggest concerns towards growing global GDP. But however, we are with the federal rate cut expected to come in September this year, that is next month, possibly around 50 basis points. We expect other central banks to lower rates as well. And if you refer to the table that we have on the screen, you may see how the rates are going to go down and what's the expectation for year end as well. With the rates coming down, we are expecting somewhat of a shift between from developed markets to frontier and emerging markets as well, where the funds will be looking to be redirected in order to gain benefit from the higher returns that are there. And that is being expected to happen from second half of onwards, where the rate starts coming down on the global side. And finally, what you also have to look out is on the commodity side. So when in a scenario where the global GDP is growing, there can be added pressure coming into commodities. For instance, if you look at crude oil, currently crude oil prices have been very much volatile, mainly due to the Middle East crisis. However, in an environment where the global GDP expanding, we may see crude oil prices picking up more. And if you look at base metals, it's the same case, where the US-China tech war that is currently going on is making prices volatile. But however, when the global GDP starts picking up as well, we will see pressure being added on to base metals as well. And the same case goes for natural gas, while gold is almost at a record high levels right now, mainly because of the global recessionary concerns that have been there due to delayed Fed rate cuts. And finally, this is one of the important slides, because this is, I think, one of the game changers for Sri Lanka. That is a possible credit rating upgrade. So if we look at the local currency, in September 2023, we first had a rating upgrade where the local currency rating was upgraded from default status to CCC minus, because we successfully completed domestic debt optimization. Now, with the final hurdle, that is the external debt restructuring hanging overhead, we are expecting a rating upgrade there once we complete that as well. So for instance, a lot of credit rating agencies have been commenting right now that once Sri Lanka completes EDR, Sri Lanka can expect a rating upgrade from restricted default status to somewhere around CCC levels. So that is something positive, very positive, that is coming our way in terms of the next couple of months. So with looking at the external situation of Sri Lanka, again, we have seen a couple of positives and negatives balancing it out. And because of that fact, we are continuing to maintain our outlook at medium low risk in terms of external outlook. Yeah. So I think next, one of the most interesting slides that we have in the presentation is the next couple of slides, where we are looking at a couple of scenarios, which is, I think, one of the most awaited and the most questioned problems that we have seen, which is what are the scenarios that we can expect from the presidential election that is coming up. To take you all through that and to give you all more clarity, let me invite Dimantha.
Thank you, Ranjan. So now let's look at the scenario analysis. So starting off, we've created 4 scenarios for you to understand the current situation in the political phase. So let's look at the 4 scenarios. So starting off, we have the base case low scenario, which we've named as the snail pace stroll, and then you have the base case high scenario, which we've named as the monorail dream. Third scenario is a super case scenario where everything goes really smoothly, and that we've named as the super grade highway. And then finally we go into the worst case scenario, we've named it as the Lankan pothole. So let's start off with the scenario 1, which is snail pace stroll. So here what we are basically looking at is a hung parliament, and then in this hung parliament you have people who are not seeing eye to eye, and with that what will happen is there will be some amount of unwillingness to take drastic decisions. So there is always delays in decisions that are taking place, and in such a scenario you have the IMF progress also sort of getting delayed, and but they are sort of barely maintaining progress or the course of the IMF programs, simply because they are likely to implement some of the governance related measures. So that is a key area where, though on the fiscal front they may be somewhat weak, there has been always complaints on the governance front that there is no actual progress. So this is something that will happen during this type of a government, and in such a scenario basically these kind of reforms can take place, and with that some amount of the progress will take place in the IMF program. And with that also another thing to look at is there will be slower than anticipated growth. So you can see something that is similar to what we are experiencing right now. So slowness is likely to take place, and with that also another thing is because there is no real fiscal consolidation taking place at a certain amount of time, you may have to look at some amount of tax hikes as well if the tax is not really broad based. So in this sort of scenario, what can we expect? The potential outcomes is that interest rates are likely to be maintained at the current levels, like 10 to 12% is what we are looking at. When there is uncertainty, when there is delays in the IMF program, rates moving up to around 12%. However, when you have positivity and some conditions being fulfilled and IMF program back on track, you will see confidence and rates coming down to around 10%. So you have certainty coming in on certain times, uncertainty on certain times. So it will go, it will be volatile here, moving up and down. So in that sort of environment, you will have uneven growth, and also in terms of awareness levels also it will be gradual awareness growth that will be there relating to capital market products. If you take there will be a sort of a slow search into capital market products because rates are broadly below 13%, and you may want to look at other options that are there. So there will be even in the equity market you will see some progress there. What's the next scenario? Next scenario is the monorail dream. Here you have a strong parliament, the IMF progress is taking place, the program is going ahead, and there's some sort of acceleration. You have some amount of fiscal consolidation taking place, SOE reforms are taking place, so you have some amount of FDI flows coming in, some amount of digitalization taking place with the digital ID, maybe some institutions may made digitalized. So that kind of scenario. So in that sort of environment, you will see increased level of financial literacy. So in this sort of scenario, interest rates are likely to be slightly lower. We are looking at 8 to 10% in terms of because there will be less demand for government borrowings because some amount of fiscal consolidation is there. So there will be a stronger search for capital market products that is likely to take place. In such a scenario, you will have strong equity market performance, and with business expansions happening at a strengthened level, you will see more IPOs and M&As also taking place. Third scenario, everything goes really well. You have a capitalistic president, you have a capitalistic parliament, IMF program being implemented ahead of schedule at accelerated pace. So you have more being done in terms of fiscal consolidation. So you require less taxes, you can lower the taxes. So we are looking at a fully digitalized economy here. In such a situation, global interest rates also supporting us with lower rates. So this kind of scenario, we are expecting interest rates to fall to around 6 to 8%. These are not scenarios which we've not experienced in the economy. We've seen this happen. So 6 to 8% interest rates, extremely strong equity market performance. You will see a large amount of the population between 25 and 45 increasingly going in search of capital market products, and then heavy business expansions taking place. Because of that, you'll have loads of IPOs and M&As happening. Final scenario. This is the worst case scenario. So a weak president, a hung parliament, this is the worst thing that can happen. So no real decisions are being taken. Very difficult to maintain the IMF program because nobody is really agreeing on anything. So in that kind of a scenario, you are more likely than not to have the IMF program derailed. First it will get delayed, then completely derailed. So you will see in such a scenario, we are likely to lose our funding sources. The financial gap from World Bank and ADB unlikely to happen. So in such a scenario, you will see they will have to raise taxes because you don't have sufficient revenue. You will have inflation coming in, currency depreciation coming in, less demand for fixed income products because you will have demand for non-liquid assets such as maybe vehicles, maybe gold, maybe real estate, because there could be another debt restructuring to happen more likely than not in this sort of scenario. So you'll have less interest in fixed income products than previously. And then very bad for the equity market, because we are likely to say initially rates moving up to around 15 to 20% and then subsequently going in further. So in this scenario, so let's now look at what we are looking at in terms of probabilities. So let's take us through to the probabilities slide, please. Right. Okay. Thank you. So in this scenario, in these four scenarios, these are the probabilities that we are looking at. Now, for the base case 1 scenario, or the scenario 1 base case low scenario, we are looking at a 50% probability. For the monorail dream, 30%, and of course lower probability of 5% for the super grid scenario. But we have a slightly higher probability of 15% for the worst case scenario. Now, if you look at these scenarios, scenarios 1, 2 and 3 are slightly onto the positive side, so moderately or highly positive. And so what you can see is there is a 85%, cumulatively 85% probabilities going into these three segments, and then which means it's slightly or more positive for fixed income and equity markets, or broadly capital market products. However, you have a 15% probability on the reverse case scenario where there is highly likelihood of negative returns that is expected to happen. Yeah, so let's look at the recommendations. Yeah. So we have the primary criteria and secondary criteria that we look at. So these are the set of primary criteria we usually take into account. So you can see that we broadly maintain the risk level, except the in terms of liquidity where it has slightly improved. So we've actually upgraded our risk level in terms of liquidity to medium low. Rest of it we've actually broadly maintained. So next slide we'll be looking at the secondary criteria. So in terms of the secondary criteria, you can see broadly we are again maintaining the risk levels. Nothing much have changed. In terms of the political risk, if you can remember, we've already upgraded or downgraded the risk level to medium high. So overall, we'll look at what will happen in terms of the when you cumulatively take all these into account. So next slide, let's start to look at the fixed income health score. Fixed income health score is likely to remain stable broadly towards the next 12 months. Why are we saying that? We think that the government is unlikely or is expected to continue the IMF program because of the program that is I'm sorry, the government is leadership or the next government that is likely to come in is likely to maintain the IMF program because of the continuous elections that are going to take place. And when you have continuous elections, you can't go for election without having the IMF backing or IMF program behind you. So because of that, we think they'll have to fulfill some amount of conditions before going into the election. So because of that, there'll be progress in terms of reforms, and with that you'll have some amount of stability that will take place. Yeah. So when that happens, what we expect is that initially rates are likely to come down, and when after that, when the economy starts accelerating, we expect rates to slightly move up. So broadly, we think after external debt restructuring and the upgrade of our credit rating, there is likelihood of rates coming down. Yeah. So let's look at the short-term view. So with the external debt restructuring happening, we expect rates to really come down below the 11.5%. So what we are expecting is the overall yield curve to the short tenors, mid tenors, and the long tenors actually come down below the 11.5%. So basically, it's mainly the mid tenors and the long tenors, because short tenors are already below that level. So here the trigger point is likely to be the external debt restructuring. Also, the slow economic conditions is also another reason why yields should be lower. So if the rates do come down, we expect basically the rates to actually or the portfolio to be reduced. So here again, this is the level that we expect the rates to actually come down to the middle of the target box. Yeah. So in terms of the long-term view, if the rates do come down, we are expecting you to reduce your portfolio. However, if it doesn't come down, there's some amount of risk there. So we think you should be investing actually in the mid-tenor bonds. So 4-year and 5-year range is where we think there's a lot of attraction. So NII wise, you'll have a strong NII that you are likely to get. So here something important to note is that a 5-year bond in 1 year's time will be 4-year, and a 4-year bond in 1 year's time will be 3 years. So with that, you will have some amount of capital gains also that is likely to come. So current level of yields that are there in the mid tenors and long tenors, we think they are actually the exact levels that yields should be in 1 year's time, once the economy has actually accelerated. So in current scenario, what we think is yields should actually start coming down. Yeah. So going into the next slide, this is how the flow is likely to be: rates coming down, and then with the economic acceleration, rates moving up. Yeah. So going into the next slide, now we'll look at the banking rates. Yeah. So here we are looking at rates to be AWPLR to be at the same level as the current levels, where it will be around the 9 to 11%, and then slightly moving up with the credit demand improving to 10 to 12%. Then we go into the exchange rate. So here exchange rate, we've slightly upgraded our view. So, yeah. So, what we are doing here is, because of the slowness of the economy, we are actually extending our expectations. So, what we are doing here is June expectations. Now, we are extending it to December because of the slowness in the economy and the depreciation. With the recovery, we are pushing it towards the first half of next year. So, our June expectations of 295 to 305, we are maintaining up to December, and then slight depreciation of 305 to 315 for the currency. And then we go into the equity market outlook. Let me hand over proceedings to Ranjan, who will take you through what our equity market outlook is going to be. So, over to you, Ranjan.
So, ladies and gentlemen, we are at the last stage of the presentation where we will be looking at the equity recommendations. Yeah. So, sorry guys. So, in terms of equity recommendations, first we had to look at what will be driving the equities going forward. So, the main factor that is driving the equity market going forward is the profitability of the market. So, if you look at the last few quarters of the equity market listed corporates, we have seen very good levels of profitability and consistent levels of growth in profitability. So, we saw Sri Lankan market, the economy hitting the rock bottom in second quarter of last year, and since then we have seen positive growth in terms of GDP, and this has also trickled down to the corporate listed profitability, where we have seen on a both on a QOQ as well as a UA basis growth since then every quarter. In terms of the forecast, we are expecting somewhere around 4.2% year-over-year growth in terms of profitability for this year, while this will further go up by about 16% by next year, which will also allow you to allow more fundamental value investing in the market as well. So, few things as I mentioned, one is the corporate listed profitability, and profitability will rise through wages as well. For example, given that Sri Lanka has a history of consumer driven growth, with the rise in real wages that we are seeing right now, both in public sector as well as private sector, we are expecting this to trickle down to consumer sentiment, which will affect boost profitability in listed corporates in the coming months. Then looking at how the SPI has behaved is also important when you are assessing the outlook for the equity markets. So, if you look at the chart closely here, we are looking at the chart average, the SPI averaging at a PER of around 12 times in the last 10 years. But now the PER has fallen drastically and hovers around the 9 times mark. So, we believe there is a lot of upside and a discount of around 21% to the average PER of 12 times we have seen in the past. While looking at the peers, this is also very interesting because Sri Lanka continued to trade as one of the cheapest in the region. If you look at the Vietnam Hanoi exchange as well as Pakistan Karachi exchange, also the Bangladesh Dhaka exchange, we are seeing Sri Lanka as one of the cheapest investment destinations, with book values almost at 1 times and very much below the peers. While in terms of PE, we may see PE also being one of the lowest once the corporate profitability is reflected to potential. And so this is a very interesting slide that we have put here, where we are analyzing how the returns of alternative investments are. And so in this scenario, we have considered the investment via dollars, investment on treasury bills, investment on land prices, while and investing on fixed deposits. So, if you look at all these alternative investments, we are seeing that equity market is continuing to remain as one of the best performing assets in the last 12 months period. We have seen equity market gain about closing on 20% by May of this year. However, we have, with the risk getting elevated a bit in terms of political risk, we have seen equity market come down during past couple of weeks. And again, we at First Capital, we are on a very bullish note on the equity markets. We continue to remain buy on the equity market. A few things that are contributing, as I mentioned. One thing, the growth in listed corporate sector profitability, while the ADR, which is also a major milestone that is creating a lot of uncertainty in the market, is also expected to finish towards the end of this year, which will also give more clarity to the market and more direction. While the upcoming presidential election and the closure of it will also give more clarity towards how the policy will behave, policy direction will behave in the coming months, 5 years as well, which will give a lot of confidence to investors in terms of direction. And then we have the stock market that is trading at 21% discount to the historical average of 12 times PE, and compared to the very much cheaper compared to the regional peers. So this will also boost investments with a possible interest rates coming down in global front as well, as global markets look for alternative investments. And finally, we have, as I mentioned again, we have the IMF program that is going on these days, and with the completion of the restructuring that we are expecting to be on track, which will also give boost to the sentiment in the markets as well. Yeah. So in terms of targets, so we had two targets. One is for this year and one is for next year. So for this year target, we continue to be, as we continue to remain bullish, our target remains same as well, where we are expecting around 13,500 levels for the ASPEI. While for next year, we expect with the growth in profitability, while improvement in GDP, we are expecting ASPEI to hit 15,000 level mark as well. So with that, we are very much on a bullish note on equity markets, and we continue to remain on a buy note as well. So coming towards the end of the presentation, I just want to highlight again how we started the presentation with the Benjamin Graham's quote, where with all when it comes to investing, it's all about managing risk, not avoiding it. So in Sri Lanka, we are in the same place right now. We have a lot of risk coming in with the presidential election down the corner, and with a lot of questions popping in our heads with the future direction of Sri Lanka. But with every risk that is there, it gives us opportunity. It gives us opportunity to collect shares that are very much at dirt price level. For example, if we look at the past 5 days, the ASPI has lost about 5%. While if you look at the last 2 months, ASPI has dropped about 10%. So these are very good price levels that we are seeing right now, and very comfortable prices to get in terms of fundamental. So when there's always a risk, there's always an opportunity. So that is what we need to take into mind. And with that, I conclude my presentation. Thank you all.
Yeah, so thank you, Dimantha and Ranjan, for that overview. So now we'll move over to the Q&A part of this presentation. So we ask the audience, if you do have any questions, to please type them in the Q&A box. We'll give you 5 minutes to do that.
Pizza or burger? Pizza, burger, pizza, burger, or pizza, burger, or pizza. Oh! Why settle for one when you can have the best of both worlds? Just like the First Capital Money Plus Fund. Get attractive returns plus instant access through a debit card for the first time in Sri Lanka. Money Plus Fund by First Capital. Enjoy the best of both worlds.
Thank you, Dimantha and Ranjan, for that comprehensive overview. And as we've heard, there is a lot to discuss. So now we'll move the floor over to the audience to ask any questions that they have, and we'll do our best to address as many as possible. So to start us off, Dimantha and Ranjan, within the political climate, there are some political concessions and giveaways that are being discussed. And given that we are a part of an IMF program where we have to meet certain targets, do we have the sufficient room for such concessions?
Yeah, so basically I think I've seen these concessions by most of the political parties being put out. So it's important to know that yes, we are in a IMF program, and we have a very high budget deficit at the moment. Now, if you really look at it, Sri Lanka, even Sri Lanka's budget deficit pre-COVID, if you exclude the presidential election years, our budget deficit has been around the 5% mark. But now you can see that after COVID, we have very high level of budget deficits, and last year it was around 8%. Over 8%. So now this time I think we can bring it slightly down to around 7.1% is our estimate. But in such a high situation, it's going to be extremely difficult to give a lot of concession. Now, how you can actually go about it is possibly you can increase the concession, and on the other side slightly reduce the base that you give it. So basically, if you say if you are giving 2 billion rupees worth of concessions, you keep it as it is, but increase the amount of concession, focus it more, and possibly reduce the base further, so that overall you will be at the same level. So otherwise, beyond that, I don't think we can do a lot of things, because what we have to do is, now we are at around 7% possibly this year. We need to actually bring it down to a manageable level of 4 to 5%. So otherwise it's really unsustainable. We'll be piling up more and more debt. Doesn't matter if you basically give do debt restructuring, we'll quickly have to go into another debt crisis very soon. So I think a lot of concessions is unsustainable, and I don't think we have a lot of room, because IMF has given certain targets for us to achieve, and actually these targets you don't really need IMF to tell us. Those are the natural targets that we actually have to achieve. So in order to reduce the risk of the economy, so basically what I think that can happen is you can actually reduce the base and increase the amount. That sort of adjustment you can do within the current climate. I don't think you can do anything beyond that.
Okay, yeah. Thank you, Dimantha. And there is also a lot of talk about tax cuts, which directly impact our progress in the IMF program so far, where the IMF has discussed increasing taxes, but the political parties, on the other hand, are discussing to potentially decrease the taxes. So if so, can this be done? And if so, how can this be done?
You want to take it up?
Yeah. So in terms of the tax cuts that we are hearing, that is being spoken a lot during the public these days. So as Dimantha explained before also, so we are right now in a very sensitive place, and so with tax cuts, what comes is a shortfall in revenues. So when a shortfall in revenue, what IMF has given guidance on is that we need to achieve revenue to GDP of 14% by next year. So in an event where we are giving a lot of tax cuts or concessions, that the what it cannot create is that we can't expect a shortfall from the IMF target, because in that case we are deviating from the target, which can hamper the progress that we have made on the IMF so far, and which can also push the current IMF timeline also out of picture as well. So what we need to be very careful is, okay, how much, okay, we can go up to some extent on tax concessions, but we need to, as Dimantha explained, we need to find some other way to bring it up as well in terms of revenue, either through broad base in the tax base, or through implementation of either new taxes. So that is something that needs to be looked at in a case where a lot of tax concessions or new tax benefits are given out. I hope I covered that.
Yeah. So I'll just add a bit onto that. Yes. So now obviously you will have some amount of, for example, you'll have some amount of a shortfall when you have, let's say, for example's sake, let's say 50 billion of a shortfall if you adjust the tax brackets, or let's say cut the pay or something like that. So in such a situation, what Ranjan explains is that you have to catch it up through some other source. Then we need to probably increase the base. Can we get it out of the non-taxpayers? Now, these are not really certain things that are there. So yes, you can broad base it, but do we have the infrastructure in place to broad base it? So I think what needs to happen is you need to first put the infrastructure in place to broad base the taxation, and then go into cost, because we've already seen or experienced what tax cuts can do. In 2019 we had massive tax cut. We've already experienced what that kind of a large tax cuts can do to an economy, and it was a very bad experience during that period. So I think we need to at all costs avoid such a situation.
Okay. Thank you, Dimantha and Ranjan. So there are a couple of questions from the audience on the equity market, which I will go into. So one of them is, what industry do you think will perform well in the equity market post-elections and given the credit rating upgrade?
Ranjan, you want to take it?
Yeah. Sorry. So we at First Capital, when are looking at the equity markets, we look out from a top-down approach. So as you may have seen our presentation, we look at the overall GDP first, then what are the sectors that are going to drive up the GDP, and considering those sectors, we position ourselves in sectors in the equity market that will support that drive. So now what we are seeing right now, and in our recommendation list, we have two priority picks. That is, one, we have the banking sector. So banking sector, we have already seen it doing very well, and it is recovering steadily. And the other sector that's the priority pick right now is the tourism sector. So something note in the tourism sector is that tourism sector is poised to do well once occupancy surpass 60% in all hotels, because up to 60% occupancies, a portion of fixed cost is added added to the books, bringing down the profits, impacting the profits. But once the 60% occupancy threshold is passed, there will be a lot of profits coming towards hotels as well. So that's what we are expecting with the growth in tourist arrivals that we are seeing right now. Then moving on, we think consumer sentiment sector is also one of the best sectors to get positioned on. That is because when an economy is growing, the first sector that is growing is consumer. And given that Sri Lanka has historically grown through consumer, we believe that consumer will be one of the driving forces in terms of growth in the coming quarters as well. Then looking at next is what we are looking at is the apparel sector. So apparel sector, what we are thinking, apparel sector is going to be the one of the best performers in the down the line, is because from one side we have already seen garment orders, increase in apparel orders coming our way as well. And second, we are seeing that we are seeing inventory, the replenished inventories that are there from US stores being fulfilled back again, which is giving us more orders. And with the possible Fed rate cut coming in September, and with a next 24 months of lower rates, we will see consumer sector picking up in the global side as well, which should drive demand for apparel and exports as well. So that is why we are picking apparel and export side as the fourth sector. And finally, we are looking at the construction sector next, because for construction sector to recover, as we have seen, one thing, either donor funded projects has to step in. So that is what happened right now. But the possible inflows that were coming from the donor funded side is mostly coming to the big companies like Access. But however, for this to trickle down to other construction companies, into smaller players, there needs to be a boost in the local, the retail construction side as well. So that is, we are expecting towards the next year end, while the real wages recover properly. So these are how our priority picks and the recommendations for the next 12 months from our side.
Thank you, Ranjan. So we have time for just one last question, and that is, what kind of outcome from the election could negatively impact the equity market? So would it be a good time to buy shares before or after the presidential election?
Let me take that question. So according to what we expect, so I think in a time of uncertainty is where you should actually get into the market. So I think as we go into the uncertainty, and as these days we are already seeing the market coming down. I think when we released this our report, the market was already trading at around 8 times earnings, and also equity market is also a good hedge for inflation. So I think you should be gradually buying into the market as we have uncertainty, because beyond that you'll have some amount of certainty, some amount of policy outlook that will sort of take in place. Also be mindful of the fact that we have some sort of a comfort in the name of the IMF agreement. So, and with the continuous elections happening, there's a high likelihood that you have to keep the IMF program sort of on course. So in such a situation, I think you'll have to keep this when you have the IMF program on course. I think there will be benefits coming into the economy, trickling down into the economy. So with that, I don't think negotiations can take place even in the IMF program when you have continuous elections coming in. So you'll have to finish the elections first, and then possibly sit down with the IMF whether we can do tweaks here and there. So with that, what I feel is opportunity is now more towards the election, or maybe possibly during the last 2 weeks of the election there will be a high level of uncertainty, and that could be a good time to sort of collect.
Yeah, just to add on to that, Dimantha, so we had to look at from the return aspect as well. So it's roughly, when you're looking to accumulate or take positions, you have to look at the return perspective as well. So if you look at the returns that the market has given so far, as I mentioned at the beginning of the presentation, we have seen 26% growth in terms of ASPI up to May. But since then, with the uncertainty that has been coming off due to the political risk as well as the delays in IMF, we have seen market fall. And if you look at the stats that has come out so far, from the month of May, we have seen the market fall by 10% within last 2 months. And if you look at the last 5 days, we have seen over market falling over 100 points for last 5 days. We have seen market come down by 5%. So I believe right now is about a good much discount what we are looking for when the markets are trading at 12,500 levels. I believe so. This is the point where we have already seen few investors taking positions in big corporates as well as the index heavies. So we have already seen people taking positions, but however, these are on very thin levels. Something to note is that when you are an equity investor, you have to act when there's blood on the streets. So when the market is green, that's when you buy. When the market is when the market is red, only when you buy. When it's green, you sell. So I think this is a perfect time, given the massive discount that the market is having right now from the 12,500 peak that we saw in May. We think that it is a very good time to start accumulating and taking positions right now.
Yeah. Thank you very much, Dimantha and Ranjan. So this brings us to the end of today's webinar, and we want to thank you all very much for joining us today, and we hope that you found the insights shared by Dimantha and Ranjan helpful as you navigate the rest of this year. And we do ask that you feel free to drop us any questions at First Capital if you have them. So with that, we are going to end this meeting. Thank you so much, everyone, and we hope you have a great day.
First Capital clinches back-to-back wins as the most valuable consumer brand in the investment banking sector, as awarded by Brand Finance and recognized amongst the top 100 brands in Sri Lanka. We thank our valuable customers and stakeholders for being a part of our success. First Capital, performance first, always.